You're listening to New Retirement Radio, brought to you by the team at Prout Financial Design.
Hello, I'm your host, Certified Financial Planner, Dennis Prout.
I'm Heidi Cartwright, Financial Advisor and RICP.
Advisors associated with Prout Financial Design may be either 1. Registered representatives with and securities offered through LPL Financial, member FINRA SIPC, and investment advisor representatives of Integrated Partners, a registered investment advisor, or 2. Solely investment advisor representatives of Integrated Partners, a registered investment advisor and not affiliated with LPL Financial. Investment advice offered through Integrated Partners, a registered investment advisor. Integrated Partners and Prout Financial Design are separate entities from LPL Financial. Dennis Prout and Nathan Prout are solely investment advisor representatives of Integrated Partners and are not affiliated with LPL Financial. The opinions voiced in this show program are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriately qualified professional before making a decision.
WWTCM News Talk 580. Welcome aboard. It's Thursday, time for New Retirement Radio with Prout Financial Design. Joining us today in the studio, among others, is Heidi Cartwright. Good morning, Heidi.
Good morning, Ron. It's great to be here today. Dennis is off this week, so it is the rest of the crew that is here this morning. And today is June 4th. And if this is a replay on Saturday, it's not June 4th. It's so today we have with us from the office, we have Nathan Prout, who is our managing director. Good morning.
Good morning.
Hold on there, Nathan.
There we go. Good morning. Great to be here.
Very good. And we also brought with us Beth Shire, who is our director of marketing. Good morning.
Good morning. It's great to be here, and I'm loving the forecast. Man, I know what to wear every single day.
I know.
It's like you live in California almost or something.
It's like an alternate dimension because it's every morning you get up and it's beautiful, it's sunny, it's in the 70s, and you don't even have to listen to the weather. You just know that.
Tomorrow you may want to bring a raincoat.
Yeah, I heard it might not last.
Yeah.
Especially for Traverse City, it's very odd to just be able to have one day after another. That's so beautiful. Right. But we're enjoying it. So thanks.
Dennis is not with us today.
That's right.
Mr.
Dennis is off, but he'll be back next week. And next week we are going to have a special guest. Paul Sagany is coming from Integrated Financial Partners. They are a group that we are affiliated with, and he's going to come and give us some of his insights on what he does as a financial person and how he supports Prout Financial Design and our affiliation.
All right.
So that's going to be pretty exciting for us. And we would love to have some questions today. If you'd like to call in during the program, we'd love to have you call in, and Ron, you can tell them how they can do that.
You can call about any kind of retirement question you have today. 947-0023. That's the 231 area code. 947-0023. You can also just use that number and text us a question or comment.
That's great. So today we're going to jump in, and every week we send out an email blast, which you can sign up for on our website. But it just gives a little bit of a description of what we're going to talk about. And I liked the quote that started our email blast today. It said, and it comes from Benjamin Franklin, 1789, "In this world, nothing can be said to be certain except death and taxes." So these are not really cheery topics to talk about, but we see over and over when we talk to clients and prospects how difficult things can be when someone passes away. And there are so many questions asked about, what do I do now? What do I need? How do I organize this?
That'd be like for a spouse or a adult child or
a parent,
yeah, whomever.
Yeah, whoever it is. And there was this article that we found from Fidelity from Jessica Malloy, and her father passed away recently. And she just wrote this article because she found a lot of things were difficult to do, and she wanted to offer some advice to people who find themselves in that situation. She told one story that I thought was interesting, that just a couple months before her father died, and he was very healthy, it was very unexpected, but they had been talking, and he told her that he wanted to be buried next to his father in New York. Well, he lived in Colorado for all of her life, and she was very surprised, and she was like, I would have never thought to do that. And she wanted to honor him, so she was very glad that they had had that conversation. And this just shows how important it is. If you have something in mind that you would like, you need to communicate that to your family or your friends so people know that, because people want to honor you and do what you want to do.
And that's right. And so many of the things we're talking about today, too, it's, death and taxes, woohoo, right? But removing that mystery and having those conversations and setting up that plan, and of course then telling your loved ones where those plans are set up so they can reference it and not have to worry about trying to discover what your wishes may have been while they might be grieving a sudden loss as well. So
right, it just adds to that pressure. Everything feels so heavy and so hard when you're grieving.
Yeah.
So having some things organized for you is really a relief and a help to the people who are trying to.
Some funeral homes or funeral services allow you to pre-plan, where you can get a lot of that down on paper.
Yeah, and even a lot of our local ones. I know we had a representative with Reynolds Yankoff here several months ago, but there's no charge to pre-plan your funeral, and I think that's true for a lot of local funeral homes near you too.
So to keep in mind that when a person dies without a will, the state of residence must sign off on all the settling of their estate in a process called probate. And we're going to go into a little bit of those responsibilities in a little while. But before that, just want to finish this article that I was talking about. Jessica also mentioned that she had to go on a scavenger hunt through her father's home looking for all these documents that she needed. And she was looking for the birth certificate, and she found the divorce decree. Her mother had the divorce decree because her parents were divorced, and she found the passport and the driver's license. Those were easier to locate, but she couldn't find the birth certificate. She ended up calling her grandmother, and her grandmother is like, oh, well, I think I put that in the baby book. So she had to go find her father's baby book. And yes, that's where the birth certificate was. So, but if her grandmother hadn't remembered that, or she was no longer living, that might have taken a long time to locate that item. So what are some of the things that you want to include either in a box or a folder or a special drawer for people to find the things that they need? You're going to need to have Social Security cards, passports, marriage and divorce certificates, citizenship papers, military paperwork. All those things are important to have when you're dealing with an estate. You also want to have contacts, your lawyer, who's your financial advisor, who does your taxes. Just have all those things written down with contact information. Also, a lot of people these days are into digital currency or Bitcoin, and how do you get to that? Maybe Nathan can tell us like what you would need to have to locate somebody's Bitcoin.
Yeah, so having a record of what trading platform your parents use, or whoever in this case, is always a good idea with those logon credentials, because otherwise it's going to take quite a while, especially if they don't have a named beneficiary, and then that has to go through probate. And then even after all that, depending on how it was bought, you might not have any hope of unlocking it to sell it and trade it in for money or whatever the case might be.
Right. So those digital assets, you want to leave instructions for those as well. You need to have your will and trust documents somewhere where people can find them. And another item I thought was interesting is she said, make sure that you write down your instruction for your pets. If you want your pet to go to a certain family member or a certain friend, or make some kind of provision for what should happen to your pet so they're well taken care of as well.
Especially if your dog is your beneficiary.
Yes, then it's very important.
Or if someone explicitly said, no, thank you.
Right.
No, I don't want the dog. You also want to have your contacts available or accessible, because Jessica was saying she did not live near her father for many years, and she did not know all of his friends and people who would want to be involved in his memorial and people she wanted to invite, but she did not know how to contact them. Also, if you have funeral plans, like we talked about, maybe you set up a prepaid funeral or something like that, you want to have that written down so that can be found by the person taking care of your estate. So that brings us to our next article about executors and trustees. So when someone dies, you can have a will, or you can have a will and a trust. An executor carries out the instructions in a will and settles the person's estate after they die. But a trustee manages and distributes assets that are held in a trust. So if you have a will, the will may say everything goes into my trust, and then a trustee could manage it from there. But
So does everybody who makes a will, or do most people who sit down with a professional to make a will, do they name an executor in there then? Is that pretty common?
it is common to name an executor for your estate. You can name a professional. It doesn't have to be a family member. It can be a friend. It's whoever you want to take care of that business of closing down all of the links and responsibilities that you had. Make sure those tax returns are completed so that everything is closed out and taken care of. So the responsibilities of an executor include filing the will with the court. That's the probate court. You may want to work with an estate attorney. It depends on how complex the person estate is. You need to notify beneficiaries, creditors, government agencies, financial institutions. I know that a lot of times the funeral home will help you out by contacting Social Security and letting them know that someone has passed away. You want to identify and value the assets that a person has. You want to pay the debts. You want to pay the utility bills. You want to pay all those expenses. You also want to, if they have a monthly subscription to Netflix or some other app out there, you want to make sure all of those are stopped, because otherwise it'll just automatically keep coming out until the account is closed. And you also have to file a final tax return for that individual.
So if you are, generally speaking, over a certain age, retired with time on your hands, you have family, you don't want to leave them a burden, all of this stuff, these important papers you mentioned, gather them up, put them in a fireproof box, passwords, right, to your, all of that. And then if you're the executor, that make your job a lot easier probably.
Yes.
Just to have all of this at your fingertips.
Hence, you could avoid that scavenger hunt story where you're calling various people going, do you know where this is? I don't know where this is. So what does a trustee do? So not everyone who has a will has a trust. You can just have a will and have someone take care of your estate. But if you want to control your money or your assets after you're passed away, an example could be you have a special needs child. You want to make sure there's provision for that child. Someone's paying their bills. Someone's making sure they're in a proper living situation. You could provide that through a trust. And that's when you could use a trust. You could use a trust if you're like, wow, I don't want my 18-year-old son or daughter to inherit hundreds of thousands of dollars, I'm a little worried about their spending habits. So you could set up something like they get a certain amount for school if they graduate, maybe when they're 25, maybe when they get their first house, and you can sort of help manage those funds after you are gone.
But you can't do that in a will.
No.
No, have to do it in a trust.
A trust is where you control in the future.
Yeah, sometimes we say create a trust when you don't trust, or like you were talking about earlier, Heidi, with that special needs situation, you can also control how quickly they receive the money, which would greatly help them not get kicked off any government programs that they might be on as well.
Right, and there are specific trusts out there, special needs trusts that are specifically designed to make sure that you don't bother or make them go over any limits, income limits, or any rules of a governmental program and lose their benefits, but they can still benefit from the assets in the trust to help their standard of living. So let's go through a list of what the trustee does. So trustee duties include taking control of the assets, so making sure you're aware of all the assets. It doesn't have to always be money. It could be a car. It could be any real estate, things like that. So you want to know what you're managing. You want to understand the terms of the trust. So you have to go through and read it and know who are the beneficiaries, how is this to be paid out, what sort of guidelines have been set down for you in managing this. You want to invest the assets, and we do this for our clients. A lot of our clients have trust accounts where we help manage the assets for them, the trustee of the trust. You also are in charge of making distributions to beneficiaries according to what the trust says. You have to maintain records and financial statements. You have to file trust tax returns. And you need to keep in communication with those beneficiaries. One of the most important things, I think, when you are an executor and a trustee is you need to keep very specific records. You want to write everything down just in case you are audited or there is some kind of conflict with the beneficiaries. You are responsible for saying, this is how I managed it, these are the expenses I paid, and have it all set in a record so that you can refer to it and that it can be looked at and there isn't any question about your management.
So the role of a trustee, as you explained, there's a lot of responsibility.
Right.
And knowledge. Generally, is a trustee a lawyer or a professional specialist?
No.
No.
Surprising.
And that's where it gets even trickier. So yeah, what if you're named as a trustee and you don't know it until you are the trustee? But also, if you're thinking about, man, hearing all of these responsibilities that my trustee has, there's no way that this person or that person has the capabilities to do that, or I don't want to burden them with that. What other options might they have, Heidi?
They have the ability to hire a professional. There are groups out there that will be corporate trustees or people who will act as an executor for someone's estate, and this is their profession and their job. Sometimes families might on purpose choose that option of a corporate trustee because it takes all of those family dynamics out of it. You know, families, we all have these different relationships within the family, and it can cause problems if somebody's perceived to have a more favorable situation than someone else in the trust. Yeah. So by taking that element out and leaving that to a corporate trustee, it can actually help the family stay emotionally healthy.
Yeah, a corporate trustee, like I feel like one of the first responsibilities or things that they provide is removing the emotion, because they will just try to follow what the trust lays out. That's their only job.
So is it common, or does it happen where if somebody says, you'll be my trustee then and handle the trust, that if there's an estate where they say, and for that, you'll receive compensation?
That can happen within the trust,
okay.
Yes.
Let's see, before we move on, I think Beth has a phone call for us, I believe. She's going to. Who's there, Beth?
Sorry, my mic was off. It's Doug from Eastport.
Doug from Eastport is on the line for Heidi and Nathan and the gang here. Good morning, Doug from Eastport. I've got to remember how to turn up the phone here. My goodness. Go ahead, Doug.
Okay. Hey, I am a successor trustee on a charitable remainder trust. Mm-hmm. So my only role is to just wrap up the trust and distribute it to 2 different charities. And it says I'm allowed to be compensated, but it's extremely vague. Is there some rule of thumb or basis or standard?
I would check with maybe a corporate trustee to find out if there's a standard fee that people receive. I myself am not aware of what the going rate is for trustees. It probably is a percentage or a certain dollar amount, but if you check with your own attorney, an attorney you work with, they might be able to give you an estimate, but it should be reasonable and competitive and not like an outlier.
Yeah, I feel like it's usually in the range of like 0.5% to 1.5%, but absolutely double check that with a lawyer.
I think that was the terms they used, was usual and reasonable or something to that effect in the actual trust document, but never really spelled out.
Yeah, and it's the same thing. They're probably not going to explicitly say it within the trust, unfortunately, as you're saying. But as long as you can prove that, I didn't take 20%, but I did take 1% because this did require some work, or what seems reasonable. Right. Because your time in that, I would say, is worth at least $50 to $100 an hour, depending on the complexity of it too. So
right, and I would have to do the final tax return, I'm assuming too. Then.
Mm-hmm. Yes. The taxes have to be closed out that way. So.
Yeah. Okay. Wonderful. Thank you.
Yep.
You want to be careful if the average is 1% and you're charging 25%. That might be noticeable and unusual. Yeah. So.
And I would say, because you touch on a lot of topics here, all related to retirement, Prout Financial Design has a specialty area, but with all of this, you have, you're not trust experts. We're talking about trusts and that, but there are trust attorneys, there are tax experts, accountants, all of these different people play a role. But Prout Financial, tell us what your specialty area is.
Ours is financial management. We do tax strategy. We don't do tax returns. We also do investment management, where we invest funds in different assets in the financial world. So stocks, bonds, ETFs, annuities, all different kinds of products. That's what we do. But what I tell my clients a lot is you need a financial team or a professional team. Mm-hmm. So when you are retirement age, you want to set up your professional team. Have a lawyer that you work with. Have an accountant, somebody who does your taxes. Have someone who does your asset management or your investments. Have all these different professionals and work with them while when you're younger, so that when you are 80, 90 years old, you've established that relationship and you can trust that person, and that person knows what you want or knows how you like things done. So you may not feel like you need all of that help, but building those relationships is really important for the long term. So that's one thing I talk to my clients about.
Yeah, so we're going to be talking about some mistakes that are irreversible.
Yeah.
But
otherwise known as fatal errors.
Fatal errors. But yeah, that just sounds too heavy especially for how nice it is outside.
Right.
Sounds
another cheery topic, right?
Sounds like something that flashes on your computer screen.
Right. Yeah, call this number. Definitely not in India right now.
Fatal error.
So, the average person, so this is for you, Ron. Guess how much the average person changes jobs over the course of a lifetime.
I saw this. Luckily, I didn't remember it. I know it was over 10, though. But if I was to guess, I would say 6 to 8.
It's 12.
12,
actually.
twice that.
Jeez. I think that's high.
I mean,
Think
like
so?
your entire working career. So, yeah, there were a lot of jobs that you probably didn't want to make a career of when you were, 16, 17, 18.
I'd say from
maybe.
16 to 24, probably.
This must be-
half of those jobs occur then, probably.
Must be for people outside of Traverse City because, once you move to Traverse City, you just want to live here forever. So
Yeah.
Right?
it must be everybody else.
Right. And that stat, that comes to us from Morningstar, but what we're going to get into comes to us from Ed Slott. So,
The Ed Slott.
yeah, the Ed Slott. So, the first mistake or fatal error, if you will, is violating a rollover rule. So, a rollover is when you might be taking money from one of your previous 12 employers and moving it from a 401k to a new 401k, or from an old 401k to an IRA, or from an old IRA to a new IRA. And if you do this in a way that is what's called a 60-day rollover, where you receive a check with an intent to deposit it into the new IRA or 401k, you are only allowed one 60-day rollover per year. And we see a lot of confusion around this because people think it's a calendar year. So like, yeah, I received a check, I deposited it, that was in June, it's January now, I'm going to do it again. But if you initiated that on June 4th of 2026, you're going to have to wait till June 4th of 2027 before you were to do another 60-day rollover. And an easy way around this is to never take possession of a check when you are moving funds. Always use direct trustee to trustee or bank to bank, if that's where you hold it, transfers. So that would be, for instance, directly from Fidelity to Schwab or whatever brokerage you're working with, or from your old bank to your new bank. Another important thing to watch out with on that 60-day rollover is withdrawing funds from a 401k payable to yourself requires a mandatory 20% tax withholding. So to roll over the full 100% of the balance, you have to come up with the missing 20% out of pocket to deposit within 60 days.
So if you leave, well, let's just say if you retired, for instance, from a position and you have a 401k with that company, can you let it sit there forever even though you're not an employee, or at some point do you have to roll it over into another account?
It depends.
Okay.
So depending on how the plan is structured, they might just let you keep it there, of course, which would usually depending on your balance as well with that 401k, or they might force you out. So
then you're saying if you want to move that to another IRA or 401k, first thing is make sure they don't send you the check. It transfers directly from one entity to the other.
correct.
But in order to do that, you have to come up with 20%. You have to pay 20% tax?
If you don't do the rollover, if you try to say, send me the check and I'll deposit it wherever,
Okay.
that's where they have to withhold the 20%. And you have to come up with that 20%, and any portion of that 20% that you don't come up with becomes a taxable distribution. And if you're under the age of 59 and a half, you get to pay a 10% penalty on that 20%.
Wow.
Which is sort of one of those little insult to injuries. And we see this on Roth conversions too. So if you're under 59 and a half doing a Roth conversion where you take money from an IRA to a Roth and you decide to withhold taxes on that because you want to give the government their fair share because by golly, they need it, right?
That's right.
If you decide to withhold taxes on that directly, you will be penalized on that portion that you withhold for taxes if you are under age 59 and a half.
See, these are the rules that really endear the IRS to all of us.
Yes.
You know, where they're really so understanding. But we want to make sure people understand this is when the check is made out to you. So if it was you, Ron, if it said payable to Ron Jolly, but if it said payable to Fidelity or payable to Schwab or LPL.
For the benefit of Ron Jolly.
For the benefit, that's called a trustee to trustee transfer, and no 20% withheld, and you're not doing a 60-day rollover.
Okay.
So you don't have to worry about that 60 days.
So another good reason, once again, before you do anything with your funds like that, you want to consult an expert because it could save you a lot of money.
That's right.
Yep.
Speaking of another fatal error as well, or mistake, is not checking beneficiary forms. So we see a lot of misunderstandings around this as well, like where somebody might be, as you were alluding to earlier, Heidi, they have a trust. So the trust dictates where all of my IRAs are going to go. Because I even named it specifically in the trust that says this IRA account shall go to this person. Wrong. So a will does not override an IRA or 401k beneficiary form. So if forms are missing or outdated, funds often go to unintended individuals, like an ex-spouse, which can lead to legal battles that generally cannot be reversed.
Right.
So check the beneficiaries on your IRA or your 401k directly with the custodian, because your trust does not dictate what happens to those funds.
Beneficiary is the bottom line. Whoever you designate is.
And you can designate the trust as a beneficiary directly with your IRA or 401k custodian, but you want to be careful about that depending when your trust was written to make sure it doesn't end up costing your beneficiaries a lot of unnecessary taxes as well.
Well, I will say that I had a client just last week who came in, and the bank that they banked at, and they had an IRA at their bank, they got sold to another bank, and that other bank, and when they went in to check their beneficiary form, they're like, oh, well, we don't have any of the beneficiary forms from your previous bank. So there was no one on as a beneficiary. So these things can happen if a plan is taken over by another plan or a bank or their companies, buy and sell companies. These kind of documents can get lost or not part of the package that gets sent to the new owner or the new managers. So check them.
And that can lead to probate, which the other gotcha of probate is you have to, like you were saying, Heidi, I believe you have to go to the state where that person lived to go through the probate process if you're trying to unwind that.
Boy, did you say a bank bought out another bank?
Mm-hmm.
That doesn't happen around
so
here.
Unusual.
I'm sure it's very, yes. No one's heard of that before, but.
Yeah. Another thing to watch out for is naming a minor as a beneficiary. So leaving retirement funds directly to minors rather than a properly structured trust can trigger court-involved guardianship arrangements and severe tax acceleration problems. So if your child is under 18, you don't want to name them as a beneficiary. You want to name, ideally, the trust as the beneficiary, which dictates who is taking care of the child should you pass away before they are 18. Oh.
And you can have different people. I know I had a trust when my children were minors. And I had someone that I designated for them to live with, the person that they should live with. But then I had another individual take care of the money part. So all of the assets were to be under the control of a different person. So you can name the same person or you can have two different people, but having somebody manage that money for the child until they are responsible is an idea that you can pursue with a trust.
That's right. And another one that comes to us is Roth conversion regrets. So recharacterization of an IRA contribution. So when you contribute money to an IRA and let's say you over-contributed, you can take that back out. But you cannot do a recharacterization of a Roth conversion. So once you do that Roth conversion, it is irrevocable. So if you hypothetically do a Roth conversion, then you sleep on it and you wake up and you say, man, I should not have converted that much to a Roth. Well, too bad.
It's too late.
A fatal error.
Fatal, yeah. Fatal mistake. I don't know. I'm trying to lighten it, but yeah. So once the transaction is completed, the additional taxable income from the conversion in that year cannot be avoided. So if that were to happen to you, you might need to look at some other gifting strategies or something like that you normally would not employ to offset maybe an unexpectedly large tax that you did not foresee.
And there can be confusion on this because when I first started becoming a financial advisor, you could undo a Roth conversion. But that law changed and you no longer can do that. So someone many years ago could have done one and undone it. You can't do that now. So laws change all the time. So that's another great reason to check with someone before you make the fatal error.
Yeah. And
just check and say, can I do this?
And we saw this with the Secure Act where they're like, yeah, we're going to take the RMD age from 70 and a half to 72. And then next year they're like, actually, we'll take that to 73. And then next year they're like, actually, full clarification, it will now either be 72, 73, or 75.
Just to make things clear.
Right, yeah. The government would not want to make anything confusing, thankfully.
In your example, if you converted too much into a Roth, if you wanted to be cautious and do half of that amount and say, okay, I think I can do the other half, does it cost any extra to do two of those conversions?
It doesn't.
For the same amount of money?
No.
Great idea, Ron.
Mm-hmm. You could even space those out over 2 tax years. So if you're saying, hey, let's plan on doing 20,000, but I'm not sure about the tax implication, we could do like 10,000 of it in November and 10,000 of it in January.
We did. I don't know if you make recommendations, but we did have someone ask if you had to recommend 1 or 2 corporate trustees, who would you recommend? If you had to.
I can tell you that we did have guests on the show in the last couple of years, Fiduciary Services North, and that was one of the services that they offer, but I can't give an official recommendation to any group, but you can check that out and maybe Google it and see who's available and interview them. Go in and talk to them and ask them questions. How do you do this? What are your values? What are the rules you follow, protocols, and see if it aligns with what you want.
Yeah, a lot of banks, I don't believe, offer that service anymore.
Right.
But depending where your accounts are held, your brokerage might offer that service as well. But yeah, it's important to interview your potential corporate trustees as well, of course.
Do you do that for clients? I know there's a lot of compliance on the radio here in public about this, but for your clients sitting down across from you, if they ask, will you do a recommendation, or do you still advise them to do a little research?
We'll provide a couple names and say you should interview these people.
Okay.
Of course, we will never serve as a corporate trustee because that would
be a conflict of interest.
Exactly.
Also, let's see. We had Beth was online texting with somebody, but they did want to know, does Prout Financial Design charge for a tax strategy appointment? Because you do tax strategy.
Tax strategy is part of our overall relationship with our clients. So that is just part of the services that we offer in the whole package that we do for our clients. So that's how we handle that. And Ed Slott is a big part of our education in that. With his expertise, and all 3 of the advisors in our office are part of his elite advisor group, where we study all these tax laws and all the fatal errors. And so that's what we bring back to our clients.
That's right. So I was reading this article, I believe it was last weekend, and it came to us from the Wall Street Journal. And the title of it is, "You Won the Battle on Investment Fees, and You're Losing the War Against Taxes."
Oh.
So.
Not Texas, but taxes.
Taxes, that's right.
Okay.
Yeah. Everybody will lose against Texas. No, wait. That's a different show, sorry. So investing can cost almost nothing nowadays until Uncle Sam comes calling. So in an index fund, you can own the entire stock market for no more than 0.03% annually, or $3 on a $10,000 investment. This is a figure so low it would have sounded absurd as recently as 20 years ago. But at the same time, what is your true after-tax return? So largely what the article is talking about are ETFs, or exchange-traded funds, which are really a hybrid that's become far more popular in recent years between a stock and a mutual fund. So they're a lot more efficient as far as the costs that are within them to maintain them than a typical mutual fund. So sort of like a stock in that way. But like a mutual fund, they own a large group of investments. So it's not just one company that you're buying when you're buying an ETF. And I thought this particular stat was very interesting. So there's a specific fund, which I won't name the name of, but the prospectuses that you get in the mail after you invest in these funds, most people are immediately overwhelmed by that. But it's very important to look at the true after-tax return of that fund. So one of these funds that they highlighted returned an annualized average of 41.1%
Woo-woo.
pre-tax.
Sounds great.
That is not bad. And this was between February of 24 and the end of 25. But if you look at page 12 of its prospectus, you'll see the fund discloses its annualized return over the same period after tax to 16.3%. So Uncle Sam earned more than the fund's investors.
So how does that work? 41% return. Mm-hmm. You wind up with 16%. Uncle Sam gets whatever the difference is there, 24%.
Yes.
When is that tax paid? Is that when you sell, or is that?
Yeah, so the fund might be selling a lot more than you're aware of and trading things out within that fund.
Capital gains.
Essentially creating short-term capital gains for you, which are taxed at ordinary income rates, versus the long-term capital gains, where if you hold an investment for longer than a year, it turns into a long-term capital gain, which is a far more favorable tax rate.
Correct.
And that's part of it as well. But it's important to look at a mutual fund or ETF's exact tax history. So you can download its year-end tax supplement, which it might be a little overwhelming, but you can usually unwind it, especially with how they have to disclose these now. But it's just very important, obviously, to look at, because that's a huge difference. So you might say, yeah, my advisor's account might not be keeping up with this index or this particular stock. Why is that? It's like, well, what's your true after-tax return as well? And that's a very important number for you to be aware of.
Correct.
So how do you become aware of that? Do you have to read all that fine print, or can you talk to your advisor?
Either way.
Okay.
So yeah, we can help you with that.
And when our portfolios are put together, that's some of the review that goes into, should we add this asset to the portfolio? Those are things that the financial analysts are going to be looking at before it goes through that filter, before it makes it to the actual allocation that we're using.
And before we even recommend it, depending on the type of account, and that might be the difference between why we recommend this strategy in your Roth versus this one in your IRA versus this one in your non-qualified account as well.
Part of your tax strategy coming into play there.
That's
Exactly.
Right.
Boom.
All right. Let's go to some stats, shall we? What do you got for us today, Beth?
All right, I do. I have some stats from Market Briefs. GameStop just authorized a $2 billion share buyback. Whoa. A buyback is when a company purchases its own stock, usually because it thinks that the current price is a good buy.
What's GameStop?
Yeah.
Just kidding.
The company has been sitting on an $8.4 billion in cash and securities. Most of it was raised during the 2021 meme rally.
Weren't they trying to make a bid on eBay recently, too? Yeah. It's crazy times right now.
Yeah.
GameStop's had a wild ride. Yeah.
With our remaining minutes, I have one question related to what you had, Nathan.
Okay.
On a text line.
Oh.
They say the Dow is going wacko today. It's up several hundred points, but to be clear, no capital gains on income tax on an ETF in your IRA until you withdraw?
Within your IRA, that would be true. Yeah.
Okay, until you withdraw the money.
Yeah, but money out of your IRA, of course, is taxed at ordinary income rates as well.
All right, thank you. About 1 minute left. Anything else for us? Beth Shire.
Yeah, so I just want to say that we do offer a complimentary meeting, and we just love to meet new people. So if you're interested, please call the office, and Melissa, Janie, or Judy would love to get you on the calendar. You can do that by 231-947-3992.
All right. Thank you, Beth Shire, Nathan Prout, and Heidi Cartwright of Prout Financial Design. It's New Retirement Radio here on WTCM Traverse City. Thank you all.
Thank you, Ron.
Ron.
Thanks, Ron.